Ever wonder how top retail giants always seem to have exactly what you want, right when you want it? It's not magic, it's a powerful inventory management system, or IMS. But what makes a good one truly great? Let's break it down. First, the best systems don't just count boxes. They create a unified commerce experience. Imagine you buy something online and pick it up in store just an hour later. That's made possible by real-time omnichannel sync. It connects the physical store, the website, and the warehouse. So the system knows exactly what's available everywhere, all at once. This prevents those frustrating out-of-stock messages after you've already paid. But what about predicting the future? Modern systems use artificial intelligence and machine learning to do just that. They analyze past sales, market trends, and even seasonal changes to forecast future demand. This isn't just about setting a simple reorder point. It's about proactively ordering the right amount of product at the right time. Of course, speed and accuracy are crucial. Simple tools like barcode and RFID scanners are game. They make receiving new stock, counting inventory, and picking orders incredibly fast and accurate. And for businesses with multiple stores or warehouses, a great IMS tracks stock across every location, making it easy to transfer products to where they're needed most. Finally, everything has to talk to each other. A top-tier IMS integrates seamlessly with your point-of-sale system and your accounting software. This creates a single source of truth for your sales data, inventory value, and financial reports. It even simplifies returns, getting those items back on the shelf and ready for the next customer in no time. Now, you might be thinking, this sounds expensive, but implementing a modern IMS is one of the best investments a retail business can make, with a proven return. Let's look at the numbers. The biggest win is reducing stockouts and overstocking. Studies show that retailers lose about 4% of potential revenue just from not having an item when a customer wants it. A good IMS directly tackles this. For example, one footwear retailer used an AI-powered system and saw a 5.3% revenue jump. They achieved 87% forecasting accuracy, which allowed them to keep more items in stock while holding 13% less inventory overall. That's pure profit. Next up is operational efficiency. Automating manual tasks saves a ton of money on labor and cuts down on costly errors. We're talking about shipping rates jumping to 98% on time and a 35% drop in order cancellations. In one case study, a manufacturer slashed parts tracking time by 68% and used 50% less manpower in the warehouse. Plus, by reducing excess inventory, you cut down on carrying costs. That's money spent on storage, insurance, and obsolescence. Reducing your inventory by $100,000 can add up to $30,000 directly back to your bottom line each year. And let's not forget the most important person, the customer. An efficient inventory system means a better customer experience. Businesses with advanced systems report 15 to 20% fewer customer service issues. When you can deliver the right product quickly, you build trust and loyalty. You also avoid the brand damage that comes from overselling online because your systems weren't synced. So, if you're looking to upgrade, what should you prioritize? I always recommend cloud-based, integrated systems. Look for a unified commerce platform that treats your inventory as one big pool accessible by any sales channel. AI for forecasting is becoming non-negotiable for staying competitive. And make sure the system can scale with your business as you grow. Now, let us dive deeper into a crucial piece of the puzzle. How an IMS handles the money side of things. I'm talking about calculating the cost of goods sold, or C. This is how your inventory system directly impacts your profit and taxes. There are three main methods: FIFO, LIFO, and average cost. The basic formula for COGS is always beginning inventory, plus purchases, minus ending inventory. The method you choose determines the dollar value assigned to the items you sell. First up is FIFO, first in, first out. This assumes you sell your oldest items first. It makes perfect sense for things like food, fashion, or electronics, anything with a shelf life. In a market where prices are rising, FIFO results in a lower COGS because you're using older, cheaper costs. This means higher reported profits. Your remaining inventory is valued at the newest, most expensive prices, which reflects its current replacement cost. Next is LIFO, last in, first out. Here, you assume the newest items are sold first. This is mostly used in the US for non-perishable goods like building materials. In an inflationary market, LIFO leads to a higher COGS because you're using the newest, most expensive costs. This results in lower reported profits, which can be a strategic advantage for reducing your tax bill. Finally, there's the average cost method. This is the simplest approach. It calculates a weighted average cost for all your identical items and applies that average to both the goods you sold and what's left. It's great for things that are mixed together, like nuts and bolts or bulk materials, because it smooths out price fluctuations. A modern IMS handles all of this automatically. It uses a perpetual system, meaning it updates your inventory and COGS in real time with every single sale and purchase. Whether you choose FIFO, LIFO, or average cost, the system does the heavy lifting, assigning the correct cost to each transaction. The most important thing is that your IMS can track not just the item, but its specific cost when it was purchased, including shipping and taxes. This data integrity is the foundation of an accurate, powerful, and profitable retail operation. Thanks for watching. If you found this helpful, give this video a like and subscribe for more deep dives into the tech that powers modern business. See you next time.